Today's Desktop Metal stock analysis was asked for by quite a few subscribers, and I'm not entirely sure why Desktop Metal stock is so popular among retail investors, but perhaps it has something to do with the story. So I remember when I first got into stocks, there was a company called Liquid Metal. There still is. Maybe some of you are aware of this or remember when this was a big deal. And I came across a demo of their product, which is this amorphous metal, and it looks really cool. And they created this little ball, and they dropped it, and it bounced, and it was really fascinating, the properties of this material, and it was going to transform every element of the manufacturing industry based on the properties of this material. It starts to sound like nanomaterials, right? The carbon nanotube that was supposed to do the same thing. Well, to make a long story short, Apple got involved, and this was supposed to be on all the cases for iPhones. And when I read the story, I think the same day that I saw their demo, I opened a brokerage account and I bought shares. The size of the company didn't matter, whether or not they had revenues or whether those revenues were substantial. None of that mattered. I was investing in a story. Well, investing in stories, as it turns out, is a very bad idea. You can see here on the left, this is the track record of this great company's revenues over time. Essentially, they're selling nothing and burning through loads of cash, and they continue to survive because they continue selling that story. So the Desktop Metal story is something along the same lines of a superior product that will transform manufacturing. It's not to say it's not real. You can see it right there. That's the P50 production platform that plenty of venture capital has sunk a lot of money into. It's supposed to transform the manufacturing industry and all sorts of industry agnostic applications. It's the most superior metal 3D printer out there. But what happened is that they went public using the special purpose acquisition company vehicle, which we didn't like. We didn't like any of the SPACs because they never treated retail investors fairly. Well, they ended up taking a lot of that money and spending it on acquisitions, somewhere around 10 acquisitions in 2021, and it started to detract the focus from their original value proposition to this be-all things for everyone 3D printing company. And Desktop Metal, as we remember it, and we've covered it extensively over the years, the value proposition here is this metal 3D printing platform, and metal 3D printing happens to be one of the big three themes that we cover for 3D printing. The other two being 3D bioprinting and distributed manufacturing, which has been quite the letdown. In fact, you could say that 3D printing in its entirety so far has been rather a letdown. Other themes that fall under the 3D printing category would be 3D modeling software, 3D printing other materials, of which many that Desktop Metal is now involved with, and there's things like more obscure 3D printing of food and things like that. Well, today we're going to talk about metal 3D printing. There's really three publicly traded stocks that are available for retail investors to participate. Desktop Metal, as we said, the most popular of the lot, though their acquisition of X1 made them less attractive in our eyes because X1 wasn't successfully growing their business. The entire appeal of this company was that P50 production platform, which hasn't been seeing the traction that we're hoping for, and management's verbiage around that hasn't instilled a lot of confidence. The other two firms, Velo3D, this is probably the second most popular because of their relationship with SpaceX. We're not going to talk about them today, but there's a research piece that accompanies this video that covers all three of these firms and provides more detail than we're going to talk about in today's presentation. You'll find a link to that in the description of this video. Then there's Markforged, a company we actually liked. It happens to be the smallest of the three. It now has a market cap of just $200 million. But they're also the most profitable when it comes to their gross margin, sitting upwards of 50%. So the last time we looked at Desktop Metal, the title of the article was Desktop Metal Stock New and Improved on Sale 50% Off. That was almost a year ago to date when we wrote that piece. Here you can see other pieces we've written about the company over the years. Well, Since that last article, you can see here the behavior of the share price, and look at that. It's 50% off again. So if you liked it back then a year ago at those prices, you must really love it now because it's 50% off again, compared to the New York Stock Exchange return of around 9% over the same time frame. That's the exchange that it trades on. Now, we're going to talk a little bit about gross margin, that is the profitability of their product offerings, which are now not just the P50 production platform, but a whole slew of other things following their 10 acquisitions. So if you go to Yahoo Finance and take a quick look at the gross margin, there's going to be some confusion. So here you can see the last 4 quarters on the right, and then the column there on the left, TTM, that's trailing 12 months. That would be the last year, actually. So the gross margin there, you can calculate it, is around 7%. That's miserable. However, this is the GAAP gross margin, and we really dislike getting into this level of detail, but we're going to because it matters in this case. Let's say it really matters. So the GAAP gross margin is reflective of amortization of acquired intangible assets that are a result of all those 10 acquisitions. And here you can see where they've done the math and they're showing the actual gross margin without that amortization taken into account, where their gross margins are in the low to mid 20s, and they expect for this year the gross margin to rise north of 30% as the year progresses. So if you're a retail investor, it probably pays to look at their non-GAAP gross margin numbers. We really don't like the idea of retail investors having to go into this level of detail, but in this case, it makes sense to. So those are okay gross margins. There's certainly nothing that is reflective of the upwards of 50% gross margins that they're promising on the P50 production platform. Let's talk real quick about amortization, just so we understand that a little bit better. So amortization spreads out capital expenses of intangible assets. So when they went and acquired all those companies, they acquired assets that they couldn't put a tangible value on. So what they do is those are things like, let's say, copyrights or customer relationships, things that you really can't quantify very well. Well, they put a value on those, and then they ascribe that value over a specific time frame. How long? Well, if you go into Desktop Metal's 10K, you can see where they've listed these intangibles: acquired technology, trade name, customer relationships, capitalized software. And there's a gross carrying amount. That's the total amount. Then there's that accumulated amortization that goes into the cost of goods sold, which, by the way, it's not common for companies to do this, and it's very confusing to your average retail investor when they do this, and then we have to go through and explain these things. The net carrying amount, that's the value that sits on their balance sheet after the amortization. So these are the intangible assets. Then there's also goodwill. This is a bucket of stuff that nobody can quantify at all. They just say, well, if we're going to acquire a company, then we look at the assets we're acquiring, which are on the balance sheet. The intangible assets, will ascribe values to those. Then we're going to pay a price that's way over that amount. What do we do with that? Well, we put it in a bucket called goodwill. And what we see in the cannabis sector, and we see here, is that a great deal of goodwill gets accrued during an acquisition, and then it gets written off later, or what they say, goodwill impairment, because the company overpaid. Look, that's exactly what happened here with Desktop Metal. You can see in the 10 acquisitions for 2021, the $640 million roughly of goodwill that went to their balance sheet, and then last year they wrote off around $500 million of that. Their two biggest acquisitions, X1 and Envision Tech, those didn't come cheap. Goodwill represented 61% and 64% of the purchase prices respectively, and that's been written off, which means they overpaid. They took all that cash that they raised through their SPAC and then blew it on overpaying for companies. So in the case of these three statements here were taken from I think it was the last article that we wrote a year ago when we were talking about the amount of goodwill that they had. And indeed, our criticisms were valid because that was written off. So indeed, they did overpay. Now let's look forward into this year for Desktop Metal in terms of the growth they're expecting. They give us this wide range, they say, to accommodate for unknowns in the current recessionary environment. The growth could be 0% to 24%. So we won't know what that is because this company has a weak first half historically and a strong second half of the year. We're definitely not going to know how well they do until we get towards the end of 2023. They have around $184.5 million in cash left on their books, and they're rather elusive as to how much of that they're expected to burn through during 2023, though cost cutting has been a big focus for them. $50 million realized annualized cost savings last year, another $50 million to be realized this year. Now, in their most recent earnings call, some of the first questions out of the gate from analysts specifically about the P50. Can you talk about some of the momentum you're seeing? How many shipments have been made year to date? Pretty basic question, right? What's your expectations for shipments this year? Kind of based on order interest you're getting. How's the pricing trended? Can this product become more meaningful impact on margins and top line throughout the year? So right away, analysts are asking about the P50. We've had questions about this for a long time. If you go back and read the articles that we've written about this company, one of the criticisms we had is that the P50 has stalled in terms of the language coming from the management team, and they continue to be evasive. And again, we see that vague answers provided by the management team that don't provide any color on the success of the P50. That's very concerning. Here's why. Here's the numbers that they provided in the latest investor deck about the P50's lifetime value. So you get several $1 million up front. You get this 10-year binder consumables extended warranty revenue. You see $4.3 million. That's recurring revenues. Overall, this translates to greater than 50% gross margin over a cumulative gross margin over the 10 years that this machine generates revenue for the company. Now, towards the end of that presentation or the earnings call, one of the analysts asked if we could start to hear names of companies that are using this. And management talked about, well, there's several automotive companies that when we ship this product to them, we'll be able to say something. And then the gentleman made a remark that was rather vague, and it said, well, we'll let them do the marketing, or we may market the customer names ourselves. And then there was a follow-up where they said, well, we actually have 1,100 different machines installed, and we're a leader in binder, and people need to look at the $250 million in revenues, or close to that we're realizing because we're a leader in binder. And it was all rather distracting from the questions that analysts had about the P50 platform. So what do we want to see for Desktop Metal? Well, first of all, we want to see better revenue segmentation. For example, they talk about 24% of revenues in 2022 came from high-margin services, consumables, and subscription, but we don't see that reflected in the 10K. They need to break that down. What they do break down is by products and services, where products is somewhere around upwards of 90%. Services is a small percentage, and they break down geography. But we want to see that segmentation in terms of this high margin consumables, the recurring revenues, right? Your consumables, services, and the subscription element of what they say is 24% of revenues. Would be great to see that broken down. Their unwillingness to provide color on the P50 production platform, firms like X1 or Stratasys, they actually provide the number of machines being sold over time. Analysts are asking for that. Why can't we get that from Desktop Metal? Why the secrecy? Are they continuing to have customer problems? This thing was deployed, 4 or 5 years ago with some marquee names that they actually named, and yet those have suddenly disappeared. So we're somewhat concerned that the original value proposition of Desktop Metal continues to be pushed aside in favor of focusing on other things. Now, the gross margins, GAAP or otherwise, need to improve, so we're looking for that north of 30% this year. Cash is in focus, so we'll see how they're able to manage that through the remainder of 2023. It all comes down to this. We're going to check back in a year to see how things are going for the firm. And in the meantime, we would continue to avoid this stock because there are just too many things, too many unknowns that we're concerned about. So just to conclude, be really careful about investing in stories. The world's biggest and greatest metal 3D printing production platform is who knows where it's at, who knows how many are being sold or how many will be sold this year. These are numbers or metrics that were not provided. Be wary of stories that change over time, so the focus is being pushed away from the original value proposition. It's great that they made 10 acquisitions in a year, but that's not always a great way to grow. We can see from the amount of goodwill they accrued and their impairment shortly afterwards that they overpaid and they blew that SPAC cash. Easy come, easy go. This company needs to improve on many fronts before we'd consider investing in it. Now, I've put up another video here on Desktop Metal that you might find interesting, but before you click that, please click the Nanalyze logo here on the right, subscribe to our channel. Thanks for taking the time to watch this today.